Okay, good morning, traders, and welcome to this live intraday strategy webinar on SB Trade Desk. Today is Thursday, May 6th. Mike Boutros with you on the horn. Great to be here, with you guys to wrap up the week. Jay, Agnes, Aurelian, Eman, Ted, always good to see you guys. And it's an interesting set as we walk into the final, or it's the close of the week into non-farm payrolls tomorrow. We got some interesting things to look at. Hey, man, I hope all is well with you. Good morning to you as well. Before we get started, appreciate any and all feedback on a little minor facelift we got to the website. We haven't updated that thing since inception 2014, so I don't know why. Our focus has always been on content and keeping the content trade oriented in all facets, but a nice little refresher there, so I hope you guys appreciate that. But what are we looking at with the markets heading into non-farm payrolls tomorrow? Here's what we look at, or here's what I'm looking at real quick before we get into any of the crosses with the yields. So slight variation on the right to the slope we were using. We were using the objective high, low, high, break, really nice rally, took out 618. If you modify that, okay, to just the parallels, we're actually right there at the median line. Interesting price action as you're starting the month. SPX, a little faltering. Obviously, Dow Jones closing at a new record high yesterday. Gold pressing resistance. Dollar yen pressing resistance, coming off resistance. So many trades that are, you would think the corollary between them is profound at this point, but each trading or marching to the beat of their own drum. So on today's menu, we're gonna hit DXY, Euro, Dollar Swiss, crude, Kiwi dollar, dollar yen, dollar CAD, gold, range at resistance, sterling range at resistance, and Aussie dollar range at resistance. Any other questions or trade setups? Feel free to throw them on the message board at any time. Let's jump right in. So as far as the DXY is concerned, we got the rebound off of key support. It fizzled out right at resistance. I've talked to you guys twice. It's been a really busy week from my end, but I hope you guys caught both those webinars this week. Fizzled out right at near-term resistance, and we pulled right back into same support, same zone, 90.82, 91, key support on the weekly basis for the dollar index. A weekly close below that zone is what we would need to validate the resumptive move lower towards 89.93. Not the favorite scenario. We're still working on the assumption that this is a key support. We could get a little bit of a stronger recovery here. All things held constant. It's the start of the month. Support is support. Weekly opening range is still intact on this one. I'll show you that in a moment. Here's what it looks like on the daily chart. So again, a couple of slopes in play here. We'll clean this up as we head deeper into the month. We'll probably drop this slope right here and even drop this one, get a more holistic view of what's going on. Just show you that low right there. So here's your monthly open. Brief stint below the 618, which again on the weekly charts never closed below. Rebounded, and we talked about this since the start of the week. We're still holding that range, guys, right below slope resistance, right below support. Monthly, weekly opening range lows, all right here into the 91 handle, 90.84. Here's the intraday. And this is the operable trade that we've been in, basically. So to start off the week, we were looking for that recovery. We were looking for the exhaustive trade. Okay, this was published back on the 4th, while above that same key zone, 90.84, 91. Here was the start of the week, ran into resistance, pulled right in. There was the play to the upside, resistance, 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 near-term break of the upslope. So sure, maybe got a little bit more to go, maybe drop back into that key support. All things held constant, it is a simple weekly opening range heading into non-farm payrolls tomorrow. Now, U.S. non-farm payrolls are expected to blow out again. So like 978,000, unemployment's expected to downtick another couple of points to 5.8. So it's going to be interesting to see, especially on the heels of some of the commentary we got this week with Yellen all of a sudden, well, rates may have to move. They're talking out of both sides of their mouth. It's just complete nonsense. But anyway, you got the inflation kind of coming back into the picture, and will the Fed have to move, and yada, yada, yada. And then all of a sudden, we get this commentary. It's going to be a lot of focus on how impactful this employment picture is going to be. Remember, this is not even the extent of the reopening, right? This is the April trade. We're really starting to pick up even more steam in the next couple of weeks as things start to really reopen. You have a wider spread, vaccines, and all this ancillary stuff that is kind of all adding together to get this real boom near term in economic activity. Now, does that help or hurt the dollar? For all purposes, we just came off support. The whole focus into tomorrow is what we do in this key range, 90.82, 91.42. That's the range that we need to see break. The level that would confirm, in my mind, in my humble opinion, that we've made a larger reversal in the DXY to the upside would have to be like 91.70, 91.80. That'd be 2 equal legs off the low. That'd be the September objective swing low, and would validate a larger breakout in price. So the dollar's right there, really well defined range between some key levels that we've been following for weeks now, and the focus is on what kind of range break we get into the close of the week. And don't forget, we're just asserting the monthly opening ranges too. So things should start getting interesting here soon. Here's Euro on the flip side of that. And I covered this in yesterday's piece. Again, on the weekly chart, quick reminder where we're coming off of, right? The range of influence, as it were, for Euro is a weekly close below 120, 119.50 to be exact. Let's just say 120, or a weekly breach above 121. We couldn't get that for the last 2 weeks. So that's the range of influence for the Euro as it pertains to the monthly opening range, as it pertains to what we're looking for heading into tomorrow. Here's what Euro looks like on the daily chart. And here's the intraday. So big pullback. Big pullback. We've been following this one since the start of the week. Here's the 5-2 update. The initial trade into the start of the week was look for a reaction down here. Okay, look for some sort of inflection. Not 1950, what is it? 1980 into 1994. It was the August high close. You had 2018 open there as well. I've removed that. It's on the weekly and daily charts, but a basic 38.2 of the drop, right? So here's what it looked like again yesterday as we were sort of closing out US trade. You were seeing that divergence right into trend support. We even noted as much to watch that divergence was building right into the lows as we were getting into that support level. Here it is, another divergent reference point. Here's the near-term breakout above the weekly open. Now the weekly range highs don't even come into like 120.80. The 618 of the drop is 20.87. The key level that we were talking about on the daily and weekly charts is 21. So here's your weekly opening range. Here's your monthly opening range. Here's key resistance zone, 2087 to 21 handle. That's where you would want to see exhaustion if Euro is heading lower. For my purposes, a breach close, like I said, above 21, it's a bigger problem at that point. It's a bigger problem at that point. Questions. Okay, so again, with where DXY is, just hovering, here's Euro hovering above support. Questions on Euro dollar. Ideally, again, ideal scenario in Mike Boutros' world, you see if you do get a downside spike in the dollar tomorrow, failure into 2080, 21, and then that would be sort of the choke point where we would need to see this thing turn over. Anything above that, you're looking for the resumptive move of the broader advance. But again, all things held even, this seems like a pretty well-developed, mature advance. The corrective move, is that the extent of it? It's a basic 38.2. We almost reached into it. 100 off the high. So if it's corrective, would still extend down to like 1940s. So be careful here. There's a high again, this is just my humble opinion, but people are going to get chopped up on this one. There's been a lot of assumptions thrown out there just on this initial move. So 21, 2087, last barrier of resistance we would need to see hold for euro. Break below 1980 needed to mark that drop towards the corrective 1940 level. That's number two. Also a similar scenario, and I apologize, I don't know what happened yesterday. I didn't notice that I had this updated 2 days in a row. I didn't notice that I wrote about this also on the previous day. So I actually wrote about it on 5-4 as well. No change. Just wanted to highlight this key support zone that we had come off of and that we were looking at this channel. This channel just broke, okay? And that's back at key support. So let me take you back real quick. Y'all remember this one? Dollar Swiss, 90.90, 90.80. I talked to you about this all last year for months and months and months. And we finally broke. It was resistance on the way up, held for 1 week before blast off. Here we are again. Quick reminder, this is the 618 retracement of the entire advance off the 2015 low, the 38.2 of the advance off the 2011 low, multi-year fib level. So that coincides right now with basic slope support off of this year's low, and we're looking for a reaction right here. That was the game plan since the start of the week. Here's what it looks like on the daily chart. So we got the bounce into the start of the week, fizzled on a near-term upslope. We talked about that being a possible bear flag. Turns out that we were right. There's the break lower. Still at support though, 90.90, 90.80. Don't forget that level. If you could have traded just off that level since July of last year, you would have been doing all right. So I'm expecting something here, guys, into the close of the week. Again, basic slope support off the yearly low. If this were to close, it's a 3-point touch, so it's a confirmed slope. If it were to close below 90.80, you're looking for a quick snap towards 90.30, 618 of this year's range. Okay. Here's what it looks like on the intraday. And here is what I showed you guys last night. So the advance, again, we've muddled right into channel support, little bounce and overnight trade. There's the break, takes you right into the weekly opening range lows, and again, that key support zone. So while technically on an objective basis, we are now probing below the weekly opening range low, that doesn't supersede basic support and resistance. We're at support. Look for inflection here. Don't take my word for it. Okay, here's the last time we came into this zone last week. Doesn't get much cleaner than that. So if we do see a break below 90.80 on a close basis today, I would expect to see an accelerated drop, 90.30 being the first initial support zone in view. If that holds, well then you're holding a real clean weekly opening range right above support into major event risk tomorrow. Breakout zone unchanged at 91.87. Questions on Swissy? Actually a pretty clean one this week. But all of these trades, guys, I say that relatively because all of these trades have been more or less range bound. And we're playing within the ranges. Now we're testing the range extremes, but I would caution you because of the event risk that was coming in tap. And you guys know me, I'm typically not the guy who shies away, oh my gosh, non-farm payroll, but the expectations are just nuts. Like, I don't remember what the spread is. I didn't check what the spread is, but you know, once you get expectations where it's plus or minus 300,000 or 400,000, well, now, you know, it's not so much a consensus anymore. And that deviation from the expectation that we talk about tends to be more prominent. But in any event, dollar Swiss, watch for reaction here at support 90.90, 90.80. Last but not least, from last night, I did want to give you guys, that was number 3. Here's number 4. A quick update on crude levels, because we had made a really big turn off of a level that we were watching last week. So remember back into the close of April, we were talking about this zone right here. 2019 high week close gave us 66.15 to 66.57. Now, last month when I presented you this chart, it converged on the upper parallel, right? So fast forward to yesterday's update, and a little bit later than expected in time, but here we are, 66.15, 66.57. It's exactly where it failed and pulled back. So I was looking for inflection here yesterday. Here's what it looks like now. Still sitting there, okay? No change to the levels. You don't really have much of a weekly opening range here because it's quite a stretch. So all things held constant, all we're treating this is near term, a turn from uptrend resistance. Here's the pullback. Guess what? This is uptrend support. So it's all the more reason why this key level right here, 65, 455 into 65, is such a big zone. Again, this is the high day close, the previous high day close from back here in March, but it's also the 618 extension off the ascent from the lows in April. The median line is there, okay? Former swing highs, nice zone to watch. So support into 64.55, bullish invalidation drops to the May open. Let's call that 63.45, monthly open, weekly open, topside breach. Key resistance still has 67.70 into 67.94. That's the objective yearly high. That is 2 equal legs off the low. So some real clean levels. No change to any of those levels on crude. Any questions here? So that was last night's update, and a quick look at the DXY. Previously, we were looking at New Zealand dollar. So an interesting move on I mean, all the commodity pairs, in my opinion, were pretty interesting this week. But here's what Kiwi looked like earlier in the week. Pretty basic. And once you identify some of these bull flags, bear flags, and they all start to break in unison like this, it just gives you a little bit more conviction. So if you didn't catch this one, we had setups across of them. I'm sure you got one of them. The break above the weekly open, 71.77, that was the level that we were talking about. 38.2, the drop. You got that breach and a quick run. Okay, so that's all over already. You're in the 618 retracement of the decline. Again, it's one of those trades, and why I always tell you not to get married. A lot of guys hear the opening range strategies and they love using them, and I encourage you guys to use these factors to assess how strong your thesis or trade idea is. But nothing supersedes basic support and resistance. So here's a breach of the weekly opening range highs, capped just a bit higher by the 618 of the drop, former swing lows. Nice move. Even slope. So all of these purple lines are derived just off of this original slope. Parallel, parallel. We're there. So for all intents and purposes, again, for Kiwi, we have a near-term weekly opening range set just above support. Here's what Kiwi looks like. Again, take a step back. Sorry to go out of order. Here's what the weekly chart looks like. Here's the zone of influence, 71.11 into 72.65. That's what we need to clear to give us near-term guidance on our next leg here in Kiwi dollar. Now, ultimately, again, in my humble opinion, I think the risk is still for a turn off of 72.65, but the range is so well defined, has been tested for 3 weeks. I think you pay attention here. So for New Zealand dollar, here's the daily chart real quick. It's just another range, just one more range. 71.11, 72.65. Look for a break here. Again, keeping in mind, this is the broader upslope off the yearly lows. We're there. So more ranges to scope out, but not necessarily a bad thing when they're happening in the beginning of the month ahead of event risk. This is what we want to see. Okay, so that's number 5. There's not really much to talk about or discuss or kind of review here. Look for a break. I mean, on the immediate front, you could scratch this. And you could probably even scratch this. Okay, slope tomorrow heading into NFPs comes in right around here, 830 region, 7130s. That's still key support. A break above here. It does shift the near-term focus into the highs, but don't forget that key resistance zone. This is still pretty major. So even if you get this extension play here, you still go get an exhaustion trade here. That's why I'm for Kiwi. I'm more on the lookout for exhaustion. I'm more on the lookout for a topside exhaustion, or at least confirmation of a turn before I start getting involved here. Capiche? That is New Zealand dollar. We'll move. I'll come back to Aussie. I'm just going in order here. So dollar yen was the next setup, and it's been quite a clean play. This week has been kind of a no play because we're kind of consolidating zone, a contraction zone right below key resistance. But the severity, the magnitude of this resistance zone is important. Here's the daily chart as it looked again a couple days ago. Here's how it looks now. So we're still holding the range from was it May 3rd? We're still trading within that single daily range. Take a quick look back to dollar yen on the weekly charts. Remember, we returned from uptrend resistance, uptrend support, back at the median line and at that key 109.68, 109.90 barrier that we've been talking about for so many months and years at this point. So we're still looking for a near-term range break here. We need to get a breach to keep the focus higher, 110.65, 111.60 on the upside. But this rebound is at risk while below this zone. And that's what the whole start of the week, the kind of conceptual game plan was. You're at resistance, that's key support. You never even made a run on key support. The lows registered somewhere around 108.80, right? The 2020 opens 108.62. That's where the slope was to start the week and the month. So you kind of look for a break of this near-term consolidation. Here's what it looks like on the intraday. Crunch, 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 crunch. And this is where, again, this is why it's earned its name. This is where retail is going to get chopped up. Lower highs, higher lows. What was that? A lot of people might have been looking at this overnight and they're like, well, there's the range break, Mike. Here we go. Here we go. And they sold here. And now they're sitting upside down in the trade. You never want to get into a range break like this 24 hours ahead of a major event risk because it very rarely follow through. Even if this does follow through, guys, support just at 108.85, just below the weekly opening range lows. That's a 38.2 and slope support. So I'm going to be a little bit more reserved on dollar yen. I do like the pullback scenario for a near-term play back towards slope support. That's where you look to reassert it or look for the inflection for that matter. But while in this range, you're right slap in the middle of the weekly range, which is only comprised of Monday's trade session. Just keep things in, always break it down to objective facts. So I'm interested. I'm interested here well below 109.68 to see what kind of reaction we get. Need a move below 108.85 to get this thing going. And if anything's going to spark it, NFPs could be the thing to do it. Questions on dollar yen. Very sensitive pair to yields, very sensitive pair to US data. Definitely a pair you'll be wanting to look at into the close of the week. All right, we are making moves. That is dollar yen. Next up, Loonie, attempting to break lower NFPs. Oh, and CAD employment on tap tomorrow here. So here's what dollar CAD looks like. First, from the weekly chart. It's been quite a decline. It's been clean in the sense that of the moves that we always say that we want to see, in that a break of downtrend support should see an accelerated drop. That's what we're getting. And even into the start of this week, guys, we said, look, if this channel support, if this one's breaking too, right? This was the downside break of this channel. If this is breaking here too, we could get another accelerated drop, 2156, 2048, just initial weekly targets if this continues. Momentum breaking into oversold territory for the first time since 2017. Well, what happened last time that broke into oversold territory rather? Let's take a look. It was right here. If the break into oversold territory back in July of 2017 had people saying, well, that's pretty extended, look at that drop, you know, this might be an oversold condition, a good time to buy. Guess what? They still had another 4%, 4.5% to go, right? This is why you want to be very cautious here. If this slope breaks and momentum closes another week below the 30 level, the floor could fall out. This thing could just continue to just plow into 2156, 2048. Now we went over earlier in the webinar, we went over the crude levels. So certainly no surprise per se. Here's crude on the weekly testing resistance. If we get this pop, guys, you know, it very could well be kind of the perfect storm to continually press this trade to a much deeper drop. Here's what it looks like on the daily chart. Even on some of the near-term slopes that we've been following, right? You can see it's been pretty structured. Here's a slope in blue, guys. I did show you this before, but just off of the high. So we were working with this magenta slope, which is kind of still what we're operating under. But basic slope, just using the highs from last year, October, January, February, March, looked like a breakout, support, and then we broke back below. Keeps this slope as resistance, and that's what it's still doing. Look at this week's price action. The high filled right again at that blue slope. So it's pretty treacherous. Sub 2246, sub 2247 on a closed basis today. Again, 2156 is the first level I got. Now, this makes this one even more interesting because we have that double whammy data. CAD employment change is expected to come out tomorrow. They're expecting to see a contraction of 175,000 jobs, with unemployment expected to uptick by 0.3 percentage points from 7.5 to 7.8%. So it's not a rosy picture by any means. Now, that being said, I must, just as a caveat there, CAD employment, relatively speaking, the size of the economy and everything, you know, taken into account, the employment data tends to be very variable. You have months where you have, last month we have 303,000 jobs created. This month we're looking for 175 jobs lost, right? So it is more or less more known to be a sort of a more variable figure than non-farm payrolls, right? You'll get the extraneous one here and there, but you pretty much get, you're working with a much larger economy. So in any event, the release of both of those data fronts tomorrow at 8:30 always presents an interesting scenario here. Okay, so here's what the intraday chart looks like for dollar CAD. 8:30 tomorrow. Watch this one closely. You know, as I was saying, we got a breakout of this early in the week, but didn't really look so convincing, did it? Here's the channel that we were looking at from yesterday. We got the pop, you know, went through the 2018 low day close, didn't quite even make it to our bearish inval resistance, 123.58, 123.65. We topped out 123.52, 53, and then moved lower. All things held constant. Again, this would constitute a break of the weekly range lows. But with that double whammy event risk tomorrow on both sides, Canada and the US, I can't jump anything new here, guys. I just don't think it's prudent. If you're holding shorts, anything sub 23.12 on break even. If not, you bring your stop to that region or higher. But the next level is down. Like I said, I don't really have much till 21.56. And 2056. Beyond that. Questions on dollar CAD? Just falling out of bed here. All right, gold, here we go. Gold at resistance. Is it still holding? Last time I checked before the webinar, it was still holding. So can't stress this enough. You guys have all seen this chart multiple times. You know what we're looking at. It's the 2012 objective high, 1795. You have that swing low from earlier back in February, 1794 or 1785. $10 range of resistance, major pivot. We tested it back into the beginning of April, all throughout April. Here we are again. The original slope from the 2018 low, a parallel, 1, 2, support, break, acceleration, resistance, just a bit higher is where that sits. So heading into the beginning of the month, there's already talk of inflation data. You got employment data on tap tomorrow. This thing could be a nice setup. Here's what it looks like on the daily chart. So the level I've been talking to you guys about is 1795 and 1804. 1804 scares me, or the reason it scares me is because it would constitute 2 equal legs off the low. So if this is not a resumption of the broader uptrend in gold, but rather more of just a corrective move before the last low. Remember, we started the year saying we're looking for a low either at 1680 or 1650. So was that the low? If we break and buckle and close above 1804, for me, that's the resumptive move. Which is why, I wouldn't be surprised if we kind of get that fake out tomorrow, pull into this region, look for a reaction here. Look for a reaction here. If things are pretty rosy and the employment's plowing through the roof and people aren't really worried about inflation, they believe Powell when he says it's quote unquote transitory, then that could be a failure point, could be a choke point to 1804. Okay, but all things held constant, we're at resistance. We're at a pretty major resistance pivot. 2012 highs, pivot last year, support, kind of plowed through both sides there on November, December, but even this year, support, resistance, just higher as 1804. Here's the intraday chart. A little bit closer look of that slope. Okay, all things held constant here, no change on the levels. Here's the start of the week. This is the 240-minute chart. So it's a 4-hour. You're looking here at the 2-hour, but nothing's changed. We rallied from support right into the beginning of the week into that first target, 1794, and it's been ping pong ever since. Okay, so big resistance zone. This whole $10 region, 94 into 1804. Looking for a reaction here. Plow through 1818 if we do get that tomorrow because of where we are in time, and it'll be the close of the week. Just keep in mind that's upslope resistance. Another point where if we were to get through, that would be an accelerated rally. We'd expect something like this, right? So interesting price action for gold. Risk for topside exhaustion, but while below 1804, heading into non-farm payrolls tomorrow. Now, could we see the 100 DMA as well? Jay, you talking about on gold? Nice catch, Jay. Sprinkle some sugar on that. Even more. Even more. Good eye. Okay, so that is gold. 2 more I just wanted to cover before we wrap things up. So sterling, I can't believe we didn't cover sterling yet, and then a real quick look at Aussie. So for the British pound, how do I explain this in words that make sense? This thing is, again, one of those trades where I'm just scoping the range. So here's sterling. I've cleaned this up a little bit just for the sake of guidance. The only thing we're focused on essentially for the broader theme is 36.75 into 40.20. Now it's a big zone. Hey, but that's where we've been since February. Big resistance, big resistance. We pulled off, and we were essentially sitting right in the middle, close to the middle of this massive weekly range. So when you see something from 1,000 feet up, if it doesn't look good from the airplane, it's probably not going to look good on the ground either. But here's what it looks like on the daily chart. Slope support off last month's low, 1, 2, 3 touch. Okay, a little bit of a consolidation. Monthly open, weekly open, all crunch, crunch, crunch. Support 37.92, 38.21. That's the break. Hey, now you got me with this 100-day moving average, Jay. It's not too far off there as well, right? Key support for the British pound. All things held constant, today as it stands is poised to close an outside day reversal off the monthly high. Well, again, way too early to make any assumptions on that, but you're seeing this range contraction, right, manifest itself all over the place. Here's what it looks like on the daily chart. And here are the levels that we showed, or I gave you guys earlier this week. So we've cleaned this up a little bit. Last week, we broke below this upslope that we were following. We talked about this key support zone, 37.81 into 37.98, my favorite Fibonacci confluence zones. So that's a 100% extension off the high, 618 retracement off the low. The monthly open for April, right, there as well. We closed the week right above it. This week, we tried to go for it again, bounced right off. Very clear range in play for the near term. So while the broader range, like I said, is 36.75, 40.20, the immediate range hasn't been changed, and that's 137.80 into 139.30. This is kind of like your zone of influence for the immediate front. It's the weekly opening range. It's the monthly opening range. Could be a bear flag here in play, right? Which is why I was looking at this earlier today. If this is corrective, that would be a choke point I'd be looking for. All things held constant, it's a simple range. We can't make any assumptions until we clear this near term. BOE didn't clear it. We got nothing. Nothing of data front or commentary or anything was able to give this thing a budge. So patience pays. It's a professionally traded market. Sterling is renowned and well known for the false break, the overreach, the throwovers. So I'm going to sit this one out again, unfortunately, but the levels are clear. The levels are clear. Range at resistance for sterling. Last but not least, talking about ranges, you definitely haven't seen the definition of a range if you haven't looked at Aussie dollar this week. And this one, again, just super, super clean. I'll take you back from the start. Aussie came into the week right into resistance. We talked about 2018 open, 78, 78.36. Key resistance popped through in an outside reversal week, failed miserably there. That's been resistance, been resistance, been resistance. Yearly open support objective 77. So that keeps the whole thing nice and tidy still for Aussie. We're heading into, guys, we're in April, May now. And this thing is still holding a very tight yearly opening range. Here's the daily chart. Pretty clean, pretty clean. Still the same pitchfork we've been following since last year. Pitchfork support, pitchfork support. Key resistance 78 into 78.25. That's the 618 of the yearly range. It's a 2018 yearly open. Resistance, key support. Hey, Jay, here's your 100-day moving average, brother. That thing's just a nice highlighter today, isn't it? All lined up into 77. All lined up into 77, right? So again, objectivity, weekly, monthly opening range, right above not only lateral support, not only a moving average, thanks to Jay, but also multi-month slope support. Something's got to give. Something's got to give. And again, guys, I'm a victim to the technicals. There are people, and again, I say people just because the online Twitter, I don't actually don't follow that many people. I try not to listen to it, but I get people from desks in New York sending me these things all the time. Hey, look at this guy on Twitter saying this. And anyone who's making any assumptions on 79 or 80s in Aussie or 74, okay, they're looking longer term. They might be doing fundamental analysis. They might be looking at the larger macro picture. The technicals, in my opinion, are very clear where we are in trend. And we are at broader multi-month, multi-year uptrend support, and support until it breaks. I hate cliches, but it is what it is. So respect this break is my point. We're seeing this all across the board, across so many different pairs. They're all set up, nicely poised. So here's the near-term picture. Again, no change to any of these levels. Immediate focus, 77.63 since I told you at the beginning of the week, into 77. Really tight range here. Here's the last update on Aussie. And here's what it looked like since the beginning of the week, guys. All we said was look for 77 into 77, 71. Look for a break of that range. Well, ping, pong, ping, pong. Now, this was pretty interesting. And we did break. I published the piece on Daily FX yesterday, like right before this broke. It came right into that 50, median line support, confluence, and just ratcheted right back up. So still the focus is on this immediate key range heading into non-farm payrolls tomorrow. Questions on Aussie? Need to close above 78.25 to mark resumption of the broader multi-year uptrend. All right, that's everything on my list. Let me know if you guys have any other questions or trade setups you're looking at heading into the close of the week. We go back, God willing, to our normal webinar schedule starting next week, guys. A quick talk about Bitcoin. I do have that at near-term resistance. Objectively, it is also not only this month's objective open, which is somewhere in the range of 57,800, but it's also the April open, interestingly enough, just a bit higher there. You could see 58,728. So here's the near-term front on the trade. This is what we looked at a little bit earlier in the week. The break tumbled into the 50 of the drop, or the ascent rather, and we're right back at resistance. Keeps the focus on sort of a break above this upper parallel for the resumptive trade in Bitcoin. Now, we did mark an outside day reversal off the lows yesterday. So if anything, the threat is for a pump higher. The whole point is, does that pump fail into the upper slope? Do we get exhaustion here, or do you get the breakout zone? So a word on that. And I think that's all I've got, guys. Keep an eye on the VIX. Last couple of days saw a little spike there, pulling back a bit, but in the right direction. And again, keep your eye on that 10-year tomorrow. 154, that's the danger zone. Anything sub 154 might be a broader shift in sentiment that we're looking for here. All right, I'll leave you guys there. Best of luck trading into the close of the week. Again, non-farm payrolls tomorrow and CAT employment at 8:30 Eastern. So stay poised, stay nimble into the close of the first week of May. And again, there's a lot more on tap, guys. All of these ranges, all of these poised crunches, the longer they crunch, the longer the contraction happens, the better the play, the better the directional guidance we'll get when it finally gives out. Agnes, same to you. Jay, same to you. Iman, Ted, Aurelian, Steve, Jay, won't get to all of you guys, but have a great weekend. Best of luck trading, and I'll see you all on the free session on Monday morning on Daily FX and right back here on SB on Tuesday and Thursday. Cheers, guys.